What happens when two of the most intelligent investors in the world build empires, but with completely different styles? One is famous for buying solid companies and holding them forever. The other built the world's biggest hedge fund by studying global trends and making bold decisions. One keeps it simple. The other looks at the big picture. Yet both ended up with billions. We're talking about Warren Buffett and Ray Dalio, two financial giants who became legends, not just because they made money, but because they changed the way people think about investing. Today, we're comparing how these two investors built their empires, what made their strategies different, and what we can learn from them. Before we begin, make sure to like this video and subscribe to our channel for more stories about people who changed the world with smart thinking. Warren Buffett was born in 1930 in Omaha, Nebraska. He started showing signs of financial talent at a young age. At 11, he bought his first stock. By the time he was a teenager, he was delivering newspapers, selling gum, and tracking every cent he earned. He was obsessed with numbers and loved reading financial reports even as a child. His early mentors included Benjamin Graham, the father of value investing, who shaped Buffett's entire approach to money. Buffett studied under Graham at Columbia University and learned how to find undervalued companies, businesses that were worth more than their current market price. This idea of buying something for less than its real value became the heart of his strategy. He was fascinated by how some investors could beat the market by thinking differently. This desire to understand value and risk led him down a path of long-term wealth building. Ray Dalio, born in 1949 in New York, also had a simple beginning. His dad was a jazz musician, and his mom was a homemaker. Dalio started investing at age 12, when he bought $300 worth of Northeast Airlines stock. When the stock tripled in value, he was hooked. But instead of focusing on individual companies like Buffett, Dalio got interested in how the entire economy works. He later studied at Harvard Business School and was deeply influenced by events like the 1971 decision to remove the US dollar from the gold standard.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
Dalio began looking at how government policies, interest rates, and global markets all worked together. His view was always broad and systemic. He wanted to understand how money moved through the world and how people could profit from these big movements. Dalio was also fascinated by history. He spent years studying past financial crises to see what patterns kept showing up. He believed that if he could understand the past well enough, he could build models that would predict the future. That belief became the foundation of his approach to investing. Warren Buffett is best known for value investing. He looks for companies that are undervalued but have strong business models, loyal customers, and good management. He believes in holding these companies for the long term, even decades. His famous investments include Coca-Cola, American Express, and Apple. Buffett doesn't care about market trends or daily price changes. He believes that if you buy a good company at a fair price and wait, you'll succeed over time. His strategy is simple but powerful. Buy great businesses, be patient, and avoid emotional decisions. He avoids industries he doesn't understand, which is why he stayed away from tech for a long time. When he finally invested in Apple, it wasn't because of the technology. It was because of the company's brand, customer loyalty, and strong cash flow. Buffett's success comes from consistency, discipline, and a clear understanding of what makes a business truly valuable. Ray Dalio, on the other hand, follows a macro investing strategy. That means he studies large economic forces, like inflation, interest rates, and political events, to decide where to invest. He doesn't just look at US companies, he looks at the entire world. Dalio founded Bridgewater Associates, which became the largest hedge fund in the world. His goal was to understand how money flows through economies and use that knowledge to make smart bets. Dalio created something called the all-weather portfolio, an investment mix that can survive both good and bad times. It includes stocks, bonds, commodities, and other assets, carefully balanced to reduce risk. He uses models, algorithms, and large amounts of data to guide decisions. Unlike Buffett, who relies on company reports and long-term thinking, Dalio is always watching short-term signals and big trends. He believes in studying history to predict the future, especially when it comes to economic cycles. Dalio's approach is more tactical and adaptive. While Buffett can sit on a stock for 20 years, Dalio might shift portfolios quickly, depending on global developments. He relies heavily on data, hiring analysts and programmers to build systems that support his investment choices. Associates, Buffett's big breakthrough, came when he took control of Berkshire Hathaway, a struggling textile company. Instead of trying to fix the factory, he used it as a holding company to buy other businesses. Over time, Berkshire turned into a massive empire that owned parts of companies like Geico, Dairy Queen, and even railroads. Buffett became a master at using profits from one company to buy another. He also used it in insurance companies to his advantage by investing the money they held, called float, before paying out claims. This gave him more money to invest without borrowing. His ability to grow Berkshire Hathaway into one of the most valuable companies in the world came from this smart use of capital. Dalio started Bridgewater Associates in his apartment in 1975. In the beginning, he advised companies on how to handle currency risks, but soon, he began managing money. His real success came when he correctly predicted the 2008 financial crisis. While others were losing billions, Bridgewater's Pure Alpha Fund made big profits. Dalio used his deep knowledge of economics to see problems coming before most people did. That's what made him famous in the world of hedge funds. His firm grew quickly and attracted investments from large institutions like pension funds and governments. His investment philosophy was based on being radically honest, testing ideas through models, and constantly learning from mistakes. Bridgewater eventually managed over $150 billion in assets. Dalio's leadership was key, but he also set up systems to ensure that the firm could run smoothly even without him. He stepped back from daily operations in 2022, leaving the company in the hands of a new generation of managers trained in his principles. Buffett doesn't like risk. He's famous for saying, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." He avoids businesses he doesn't understand, like crypto or complex tech startups. He likes companies that are predictable, safe, and profitable. He also believes in staying out of debt and keeping a large cash reserve for safety. His approach to risk is to know exactly what he's buying. He looks at company earnings, long-term growth, and how well the business can survive during tough times. Buffett is not impressed by big promises or flashy innovations. He wants solid performance and strong leadership. Dalio believes risk is part of the game, but it needs to be managed wisely. He focuses on diversification, meaning he spreads money across many different investments. He also believes in preparing for the worst. That's why he created the all-weather portfolio, a mix of stocks, bonds, gold, and other assets that perform well in any economy. Dalio also looks at risks other people ignore, such as political conflict, international debt, and income inequality. He believes these can shake markets just as much as business earnings. His strategy is not about avoiding risk completely, but about designing systems that can survive in any condition. He often talks about the concept of radical transparency to manage internal risks within Bridgewater. He believes open conversations about mistakes and risks allow the team to fix weaknesses before they turn into problems. It's a mindset that balances confidence with humility. Buffett keeps his personal life simple. He still lives in the same house he bought in the 1950s. He drives a modest car and loves eating McDonald's and drinking cherry Coke. He doesn't believe in flashy spending. His focus is on building value slowly and staying disciplined. He's a believer in clear thinking, long reading hours, and doing nothing when there's nothing smart to do. Ray Dalio, on the other hand, is more philosophical. He wrote a best-selling book called Principles, where he explains how he runs his life and his company. He believes in radical truth and openness, where people are encouraged to speak honestly, even to their boss. Bridgewater is famous for using systems and data to make decisions. Dalio even created an algorithm to rate employee decisions and performance. While Buffett trusts instinct and experience, Dalio trusts data and structured thinking. Dalio sees life as a series of cause and effect patterns, and he builds systems to follow them. Dalio also talks about meditation and mindfulness as part of his philosophy. He believes that managing stress and thinking clearly under pressure are crucial for success. His views on life mix Eastern and Western ideas, blending logic with intuition. Buffett has promised to give away 99% of his wealth to charity. He started the Giving Pledge with Bill and Melinda Gates to encourage billionaires to donate most of their fortunes. So far, he's donated tens of billions to health, education, and poverty programs. He believes that money should serve a greater purpose and that society benefits when the wealthy give back. Buffett also inspires younger generations of investors to act with ethics and humility. Dalio has also turned to philanthropy. His Dalio Foundation supports education, ocean exploration, mental health, and criminal justice reform. After stepping down from daily operations at Bridgewater, Dalio now spends much of his time thinking about how to fix economic inequality and help the world. He funds research projects, donates to public schools, and speaks openly about the dangers of wealth gaps. His goal is not just to give money, but to understand the deep problems facing modern society and offer solutions. Dalio has donated over $1 billion through his foundation, and continues to focus on public education and community development, especially in underprivileged areas. Focus on quality, be patient, and let your money grow over time. His success is built on discipline, clear thinking, and long-term focus. Ray Dalio teaches us to think bigger. Understand how the world works, stay informed, and plan for the unknown. His success comes from studying patterns, building smart systems, and staying calm when markets shake. Buffett shows that simplicity, patience, and trust in good businesses can create long-lasting wealth. Dalio shows that deep analysis, openness to data, and managing risk wisely can make you stronger in uncertain times. Both men have proven that with the right mindset, anyone can build wealth over time. Their methods are different, but their success is proof that more than one path leads to financial greatness. Warren Buffett and Ray Dalio show us that there's no single way to build an empire. Whether you love simple ideas or big systems, what matters is being smart, staying focused, and thinking long-term. If you learned something new today, don't forget to like this video, subscribe to our channel, and hit the bell icon so you never miss more stories about people who made history through strategy and wisdom. Thanks for watching, and remember, it's never too early or too late to start thinking like an investor.